Hey there, money mindset investors. Want to make your money work for you? Dividends are the key. Imagine getting paid just for owning a piece of a company. That's what dividends are all about. They're like getting thank you checks from your stocks every single month. This isn't about getting rich quick. This is about building long-term wealth. We're talking about owning great companies that pay you to hold them. Forget day trading. This is about sitting back and watching your money grow. In this essay, we'll break down a $22,000 dividend portfolio. We'll look at how it generates passive income every single month. Get ready to learn how to build your own dividend powerhouse. So, how do you build a dividend portfolio? It starts with diversification. Diversification is the cornerstone of a solid investment strategy. It means spreading your investments across various asset classes and sectors to minimize risk and maximize potential returns. Don't put all your eggs in one basket. Instead, spread your investments across different sectors. This way, if one sector underperforms, the others can help balance out the losses. Diversification is like having a safety net for your investments. Think about it like this. What if you only invested in tech companies? If the tech sector takes a hit, your whole portfolio feels the pain. The tech industry can be volatile, and relying solely on it can be risky. Diversification helps you avoid this pitfall, but if you're diversified, you're protected. A diversified portfolio can include a mix of stocks, bonds, real estate, and other assets. This mix helps cushion the impact of market fluctuations. A well-diversified $22,000 portfolio might have stocks in sectors like technology, healthcare, consumer staples, energy, and financials. Each sector has its own strengths and weaknesses, and together, they create a balanced portfolio. Consumer staples, these are the companies that make the things you need every day, like food and cleaning supplies. These products are always in demand, making this sector relatively stable. Healthcare, people always need healthcare, making this a stable sector. Healthcare companies provide essential services and products, ensuring consistent demand regardless of economic conditions. Energy, we all need power, and energy companies provide it. This sector includes traditional energy sources like oil and gas, as well as renewable energy sources like solar and wind power. By diversifying your portfolio, you reduce your risk. Diversification helps you manage risk by spreading your investments across different sectors and asset classes. This way, you're not overly exposed to any single investment. If one sector struggles, the others can help pick up the slack. Diversification ensures that your portfolio remains resilient, even in the face of market downturns. It's a key strategy for long-term investment success. Now for the fun part, monthly dividends. A well-structured portfolio can generate passive income every single month. But remember, not all stocks pay dividends every month. Some pay quarterly, and some even pay annually. The key is to find a mix of stocks that pay dividends at different times. That way, you'll have a consistent stream of income coming in. For example, you might own some stocks that pay in January, April, July, and October. Then you could add stocks that pay in February, May, August, and November. Finally, you could round it out with stocks that pay in March, June, September, and December. Let's talk about some high-yield dividend champions. These are the companies that offer investors a substantial return on their investment through regular dividend payouts. These are the companies that pay out a large percentage of their profits as dividends. They are often sought after by income-focused investors looking for steady cash flow. Remember, high yield doesn't always mean high quality. A high dividend yield can sometimes be a sign of a struggling company trying to attract investors. It's crucial to do your research and choose companies that are financially sound and have a history of paying consistent dividends. Look for companies with strong balance sheets, stable earnings, and a track record of dividend growth. Here are a few examples of high-yield dividend stocks that have stood the test of time and continue to provide reliable income to their shareholders. Real estate investment trusts, or REITs, are a popular choice among dividend investors. REITs are companies that own and operate income-producing real estate. This can include shopping malls, office buildings, and residential complexes. They're legally required to pay out a significant portion of their profits as dividends, often making them a reliable source of income. Another example is Master Limited Partnerships, or MLPs. MLPs are publicly traded partnerships that typically operate in the energy sector. They own and manage energy infrastructure like pipelines and refineries. They're known for their high dividend yields, which can be very attractive to income-focused investors. Remember, investing in high-yield stocks comes with risks. High yields can sometimes indicate underlying issues within the company. Make sure you understand the company's business model and dividend sustainability before investing. It's important to assess whether the company can maintain its dividend payments in the long term. Diversification is also key. Don't put all your money into one high-yield stock. Spread your investments across different sectors and companies to mitigate risk. By carefully selecting high-yield dividend champions and diversifying your portfolio, you can create a steady stream of income while managing potential risks. With the right strategy and due diligence, high-yield dividend stocks can be a valuable addition to your investment portfolio. Want to make your monthly dividend income even bigger? Here are a few strategies. First up, reinvest your dividends to buy more shares of stock. This is like a snowball effect. As you buy more shares, you'll receive even more dividends, which you can then reinvest to buy even more shares. Next we have, don't invest all your money at once. Instead, spread out your investments over time. This helps reduce the impact of market volatility on your portfolio. Lastly, high-yield stocks can be tempting, but they also come with risks. It's crucial to monitor your high-yield holdings and be prepared to sell if the company's fundamentals deteriorate. Growing your portfolio. Reinvestment and strategic diversification. Building a dividend portfolio is a marathon, not a sprint. It's about gradually growing your income stream over time. One of the best ways to grow your portfolio is through dividend reinvestment. By reinvesting your dividends, you're buying more shares of stock, which will generate even more dividends in the future. It's a virtuous cycle. Another crucial aspect of portfolio growth is strategic diversification. As your portfolio grows, you can continue to diversify across different sectors and asset classes. This helps to reduce your overall risk and enhance your potential for long-term returns. Navigating risks, market volatility, and dividend sustainability. In this section, we will delve into the intricacies of market volatility and how it impacts dividend sustainability. Understanding these concepts is crucial for any investor looking to build a resilient portfolio. Dividend investing is not without its risks. While dividends can provide a steady income stream, they are not guaranteed. Market conditions can change rapidly, and companies may face financial challenges that impact their ability to pay dividends. It's important to be aware of the potential downsides and how to mitigate them. Risk mitigation strategies are essential for protecting your investments. This includes understanding the financial health of the companies you invest in and staying informed about market trends. Market volatility. The stock market can be volatile, and even the best dividend-paying companies can see their stock prices fluctuate. This volatility can be caused by various factors, including economic data releases, geopolitical events, and changes in investor sentiment. Don't panic sell if the market takes a downturn. It's important to stay calm and focused on your long-term investment strategy. Panic selling can lock in losses and prevent you from benefiting from potential market recoveries. Dividend cuts or suspensions. Companies can cut or suspend their dividends, especially during times of economic uncertainty. This can be a result of declining revenues, increased expenses, or strategic decisions to preserve cash. It's crucial to research a company's dividend history and financial health before investing. Look for companies with a strong track record of paying dividends and a solid financial foundation. This can provide some assurance that they will continue to pay dividends in the future. High-yield stock reliance. Relying too heavily on high-yield stocks can be risky, as these companies often have less room for error. High-yield stocks may offer attractive returns, but they can also be more vulnerable to economic downturns and financial instability. Diversify your portfolio across a range of dividend yields to mitigate this risk. Diversification can help spread risk and reduce the impact of any single investment on your overall portfolio. By investing in a mix of high, medium, and low-yield dividend stocks, you can create a more balanced and resilient investment strategy. Conclusion: achieving financial freedom with dividend investing. Building a dividend portfolio is a powerful way to generate passive income and achieve your financial goals. By investing in quality companies that pay consistent dividends, you can create a stream of income that grows over time. Remember to diversify your portfolio, reinvest your dividends, and stay informed about the companies you're invested in. With patience and discipline, you can build a dividend portfolio that provides for you and your loved ones for years to come. Explore more resources for dividend investors. Want to learn more about dividend investing? Check out these resources. Seeking Alpha. a website that provides in-depth analysis of stocks and other investments, including dividend stocks. Dividend.com, a website dedicated to dividend investing, with information on dividend stocks, ETFs, and more. Your brokerage account. Many brokerage accounts offer research tools and screeners that can help you find dividend-paying stocks. Thanks for watching.